Today I am going to explain some very important topics of financial management. You subscribe this channel so that you can get the notification of my latest videos on your mobile phone. What is debt service coverage ratio? This is one very important ratio in financial management. Debt service coverage ratio is a financial metric used to assess the entity's ability to generate enough cash to cover its debt service obligations like interest, principal amount, and lease payments, etc. A DSCR of 2 is considered very strong, and it shows that a company can cover 2 times its debt. The minimum DSR requirements is between 1.2 and 1.25. The formula to calculate DSCR is net operating income upon debt services, that is, profit after tax plus depreciation plus interest plus non-cash expenses divided by dividend plus interest plus repayment obligations. The question here is, define capital budgeting. Which decisions are taken in this? So here, capital budgeting. First we see what is budgeting. Budgeting means allocating certain amount of money for certain expenditure or specific expenditure can be called budgeting. Then capital budgeting means allocating money or keeping certain amount of money for purchase of fixed assets is called capital budgeting. So now when we are going to purchase assets, a big amount of money is required. Then here you have to see when you are spending that big amount of money, what return you will get, what profit you will get. So the allocating a big amount of money for purchase of assets is called capital budgeting. The next question is, write a note on optimal capital structure. Here we need to understand what is capital structure. Every industry, every business requires a big amount of money to start the business and to run the business. This amount can be raised in 2 ways, by borrowing and by issuing shares. Borrowing from banks, from financial institutions, from friends, relatives, or any other source. That is called borrowed capital. The borrowed capital is a kind of loan, and that has to be returned along with interest. So borrowed capital always increases the financial obligation of the business. It increases the financial burden on the business. Whereas money raised through equity is a permanent capital of the business, and it does not raise the financial burden on the business. It is called permanent capital because the money invested by the shareholders is not to be returned to them. The shareholders are to be paid dividend depending upon the profits of the business. So it does not increase. Equity capital does not increase financial burden. So capital structure is the blend of borrowed capital and equity capital or owner's capital. The proportion of borrowed capital and equity capital differs from industry to industry depending upon its requirements. The optimal capital structure is the perfect blend of debt and equity that maximizes the wealth of the business. At the same time, it reduces the cost of the business also.